I suppose the question I think a lot of people will have is, does that mean 25 is going to be great? And when it comes to homeowners or investors or whatever regarding the real estate market, what that generally means is a price is going to rise. So a price is going to rise. What sort of out of 10, how would you rate you and I as quality forecasts?
I'd put that at a hard 0.
Yeah. It's definitely a low number, right? There's a lot of people out there that try and predict these things. I think the classic saying is sort of like all economists make a living out of making predictions, but none of them actually keep track of how right they are.
Yes, the economists have predicted 15 of the last 2 recessions or something. Welcome to the LoweDown. We're here at the start of 2025, season 2 of the LoweDown. I'm here with my great friend Adam Coburn, and we're going to talk today about whether the housing market is going to thrive in 25. How are you? Happy New Year, Adam.
Happy New Year to you. Did you have a break?
I did, yeah. Got away for a couple of weeks. It was fantastic.
Yeah, good. Yeah. The weather some people say the weather has been whatever. I can't say that on camera, right? Yeah. I say it's been highly variable.
Yep, fair enough. Yeah. That sound like a true economist.
It's been rough, but now here we are back again, ready to get into it.
That's right. And what do you think? Survive to 25 was, the sort of prior mantra through 2024?
That's been a mantra throughout 2024, hasn't it? We were just talking just off here before, and my take on it was that survive to 25 was just a way of making us feel okay about having to get through 24 because it was so rough. I suppose the question I think a lot of people will have is, does that mean 25 is going to be great? And when it comes to homeowners or investors or whatever regarding the real estate market, what that generally means is a price is going to rise. So a price is going to rise. What sort of out of 10, how would you rate you and I as quality forecasts?
I'd put that at a hard 0.
Yeah. It's definitely a low number, right? There's a lot of people out there that try and predict these things. I think the classic saying is sort of like all economists make a living out of making predictions, but none of them actually keep track of how right they are.
Yes, the economists have predicted 15 of the last 2 recessions or something.
So I suppose we have to put a caveat on this conversation, don't we? That says really we can't make forecasting.
No way.
We can't make
no
forecasts any better than anyone else, and that's pretty bad.
Yeah. That's right. You can take the temperature, I think, for the current climate, and you can look historically, and you can make some basic, some basic ideas about what might happen. But invariably, you'll get it wrong if you try to, and particularly if you try to be too precise. False precision.
Totally. But everyone loves to do it, so let's have a chat about it anyway.
So one of the things that comes up all the time, and I'm sure you get this out in your day-to-day running around, Adam, is that people are looking at the interest rate environment, saying it's very high right now. Everyone's talking about it coming down because of the economy. And so this sort of optimism that we tend to see, particularly from the talking heads and the kind of, the newspaper articles, and then you get the people, market players like buyers and sellers start talking about it. There's this idea that we might start to see, capital gains again. That's kind of the view that you see from some
because interest rates coming down.
Because interest rates coming down. Right? What do you think about that, Jimmy?
Well, for a start, you said you just said now that interest rates are high, but are they? Are interest rates high?
Depends on what you
they've
mean.
come a long way off their peak. You're now looking at interest rates in the 5s, and if you look at the long-term interest rates, say especially the longer-term interest rates, 3 to 5 years, the average 3 to 5 year interest rate is mid-6s.
I think it's relative to value, the price though, right? And the higher prices are, the more that interest rate, that sensitivity of like whether they're high. It's not necessarily that interest rates are high relative to 10 years ago.
10 years ago,
It's are they relative to the amount of borrowing that people have today on the current value of people's houses. And I think when we had interest rates at 7%, I think they were at that point high relative to the debt, but but with price declines and with interest rate declines, it's probably significantly more imbalanced to being more normal today. Not high, but not necessarily super cheap or anything either. But definitely you're right. Like if you look over the last 40 years, like 5.5%, 5.5%, and you can borrow for relatively long-term rates in the 6s. That's relatively cheap borrowing.
It's not high. So, but as you say, it's all relative, and people's memories are very short for a start. But also, people aren't thinking about how much. What was the interest rate 10 years ago? What they're thinking about is what were my payments last month.
Yeah, yeah.
And so when they go from 2.5% to 7.5%, and their payment goes from whatever $2,000 a month to $4,000 a month, whatever the case might be, that's what they're feeling, right? So the other thing is, of course, it's more the direction of travel that people are thinking about, really, as opposed to what are the interest rates today, the actual gross number compared to long-term averages. So the direction of travel in the last 9 months. Would it be something like that? For a lot of 2024, the direction of travel has been downwards, right? And we've seen reductions in the official cash rate, the OCR. We're now at 4.25%.
What did it peak at? 5.5?
Oh gosh, was it 5.5? I reckon that's 5.5.
Yeah, 5.5.
I think it was 5.5, and we're now down to 4.25. So we've had 125 basis points off. So yeah, the direction of travel is down, and yes, there's a lot of talk out there about, does that mean house prices are going to go up? As if the interest rate or the movement of the interest rate is the only thing
factor
that drives it. Now, some investors do say, and most people who buy houses are not investors, but we're talking about an asset and the relationship between an asset price and interest rate. So their thinking or their thought process, I think, is relevant. Some investors say that interest rates are to asset prices what gravity is to matter, right? The stronger the gravity is, the harder it comes down. And the higher interest rates are, the further prices fall. So that would suggest that interest rates coming down, prices going up. But it's only one of several drivers, isn't it?
Especially in the short medium term.
Yep.
I think that is a true statement. We know that if the cost of capital gets cheaper, assets go up, and we know if it gets more expensive, assets go down. There's no doubt there's that relationship, but it's not some perfect scaling thing that happens in a 3 month or 6 month or even
So if the interest rates come from 5% to 4%, that's a reduction of 20%. 1 out of 5. That doesn't mean values go up by
20%. Exactly right. Yeah,
100%. So all of these different fundamental drivers feed into sentiment, doesn't it?
Yeah.
And there's no question that interest rates are a big driver of the fundamentals, but there are others, aren't there?
Yep.
Like, what are some others?
Well, obviously the general economy is how's the economy doing? And of course, interest rates will play a role in that, which is part of the reason why they're going to be important. But it's going to take time for that to flow through.
Why are interest rates coming down?
Because the economy's bad.
Because the economy is pretty stuffed. I mean, we've had GDP reductions. Gosh, are we in the third recession in the last 3 years?
Something like that.
I think we're in the third recession in the last 3 years. And GDP per capita, of course, is down something like 3% or 3.5% on a year ago. Now, if you looked at your budget and you went, okay, well, I was at $1,000 and now I'm 3.5% down, so $965. Most people could cope with that, but it doesn't work that way. For 3.5% of people, they've gone from 100 to 0, or something like that. So it's always at the margin. So a bunch of people have been crushed. Their budgets have been crushed, and it's really painful. So that's a big reduction over the last 12 months in real GDP.
And if we look at sentiment and the economy in Wellington, it's particularly bad, isn't it? Because we've got government sector cuts, which is still coming, more to come. So sentiment about Wellington as well is just generally bad.
Wellington is in the doldrums.
It really is.
There's no question about that.
Yeah.
And it's not just public sector job cuts either. There are other reasons as well. I mean,
work from home. No one's going into the city. You've got retail struggling. You've got hospitality struggling. Things closing down.
You've got people grumpy about various things the council are doing, and pipes not fixed, and I don't know, cycle lanes, the lanes that a bunch of people love to hate.
And there's no real urgency, right? There's no expectation of capital gains. So while you get the odd article and you get the odd optimism from an economist or someone like that talking about it, the reality is, I think the market's being quite efficient and is not in an urgent state. Like, people can't afford it. They're only buying for need. They're not buying through some kind of sentiment that they don't get in now. There's no FOMO out there, is there?
No.
So, and we wouldn't expect that to come for a long time from now.
Why do people get FOMO and worried about missing out? Well, they see evidence of prices going up, and that increases it. I think during COVID, there was a bunch of FOMO that came in because everyone expected all these expats to return home. and all this massive wave of people coming back was going to increase the demand and push prices up when they arrive. So better get in now and buy before they come in, and that actually drove the prices up in and of itself. The anticipation of that.
There were a lot of factors going on from
all
COVID.
sorts.
I mean, people just upgrading their lifestyle because suddenly they're faced with their own mortality, and it's like, let's just. I mean, people were buying boats and golf clubs and.
Well, there was a major focus on lifestyle, wasn't there? So being in the city was less desirable than being a bit further out, where you had big gardens, and that was sort of accentuated by the work from home phenomenon as well. Of course, wasn't it? People didn't have to come into town. But I mean, coming back to the topic here. What are prices going to do in 2025? So you started talking about it before. Are you sort of suggesting that you think prices are not that likely to run away to any great extent?
There's a couple of points here. One of them is that while the Reserve Bank, and we've got the dot plot here, is anticipating, another 1.25%, 1.5%. Drop over the next sort of 18 months, right?
Yeah, over the next 18 to 24 months, I think.
Yeah, 1.5 to 2 years. While that will...
So that's pretty slow.
Yeah, but also...
That's pretty slow, isn't it? We've had 125 basis points in the last, what has it been, 6 months, since August? 6 months. So the same reduction again over the last 24 months.
But also, these tend to impact short-term rates more than long-term rates.
Absolutely.
And if you look at what's going on in the US, there's a lot of talk now and a lot of about inflation perhaps not getting under control as quickly, particularly with the stimulus that Donald Trump is likely to bring in.
Yeah.
And it's the wholesale rates that drive what the banks charge us for our long-term rates. So that could have more impact.
Just because there's not enough ability to borrow from domestic deposit holders.
Exactly.
Yeah. The degree of saving doesn't match the degree of borrowing.
So I think,
and the US, what you're saying is that the sentiment in the US is positive because it's anticipated that a Trump-led government will be pro-business and pro-growth, so that might lead to inflation. So interest rates are under pressure upwards.
Plus, they're seeing upwards pressure on CPI again, which they haven't, which people weren't anticipating last year.
Share market's booming, and
So I think that's going to drive long-term rates more potentially than what we're seeing with the dot plot here. The other thing is that this could be wrong because these are
it's 100% going to be wrong.
Yeah, because even the Reserve Bank
just how wrong
ends up changing what they're doing based on the new
data. That's right.
So interest rates are only one component, and they may or may not pan out how people think. So that's
what you're saying is in terms of what's happening in the US. If you're expecting or hoping for longer term interest rates locally here in New Zealand to come down a lot or come down quickly, that's less likely to happen now.
I think so. Yeah. I think. I mean, again, there's no guarantee or anything, but that would be
less likely.
It'd be a reasonable.
Less likely.
Yeah, it's less likely, and so that's one thing. It may not pan out that the interest rates actually drive the market as much, even if they were a big driver. And then we need the economy to come right. We need sentiment to come back, and it's a slow process. I mean, there's a reason why the housing market is a 7 to 10 year cycle, it's not a 1 year cycle, a 3 year cycle, a 4 year cycle. It's a long game. But
the movements of supply and demand shift slowly.
But we saw a 30% increase in volumes last year. Now, admittedly, that was off a very low base.
Very low.
And so we're still about 25% below the long-term average. Now, when you look at that, one of the things about that long-term average is it's excluding, there's almost no off-the-plan sales anymore. So part of that 25% to get back to the long-term average has to be made up of, when we have a return to being able to sell things off the plans. So that's probably minimum of the second half of this year, I would think, maybe even next year.
I thought at least, yeah.
And at the way things are going, but we'll see. But the point is that if you take that out, the unit turn off-plan sales, we're actually not too far away long-term volumes for your standard family home and your sort of resale.
I've never looked at that data. I mean, what percentage of sales on average?
Haven't done the maths either, but it's a reasonable chunk. But it's probably not 25% of them. So it's not another increase to 25, but it might be 10. In the sort of 2021 type 2020
at the peak
market,
peak activity.
But that'd be interesting maths to do. Maybe we should do that. And but either way, the point is that will take a chunk out of what we need to return to the long-term average. And so things aren't as bad. I remember if you think about history. I mean, history doesn't repeat, but it rhymes. We've talked about this before. But if we take the last crash, which was the GFC, in Wellington particularly, we took 7 years. So bottom was about March 2009. It was about 10% drop from the peak. And it took from then, it went sideways in Wellington, literally, like there was no gains or decline for 7 years until 2016, where there were capital gains again. Now, obviously, it could be quite different this time. We don't know. If anything, though, I think things are worse. And we haven't seen an economy like this in Wellington since 1991, right? things could be tougher and take longer for all we know. So I think 70% of houses in that time would sell and 30% wouldn't. We're probably sitting somewhere around like that at the moment.
And I'm pretty sure that I was just looking at our data, our low-income data, and our conversion rate from list to sell in 2024 was exactly 70%.
Well, there you go. So, and we, as you can see in what we've got coming on this year, we've had a big influx of stock. We've had our largest week with 43 properties on the market this week. It was a good start to the year. So we could see volumes back to long-term averages without prices going up. Now that's good for homeowners, it's good for real estate agents. Obviously, we need turnover to actually, make money. But the reality is, it also means that people can trade their houses, and that's a good thing. You need liquidity in the market. Otherwise,
good for buyers, good for sellers.
So we don't need capital gains for things to just be better, right?
It's been tough. It's been tough for buyers and sellers over the last few years. All that uncertainty and the risk involved, and the sort of stress that causes, and so on. And I think we've talked about it before that we're kind of hoping that. This year we see more of a normalization of the market as opposed to prices going up. Just a stable market where you have more demand matched with more supply, therefore prices reasonably stable, but greater turnover. And the net effect is people can just get on with their lives.
That's right, exactly. And if it does take 3 or 4 or 5 years, I mean, obviously there are some people that's not good for. I mean, if you bought in 2021 and you're sitting in negative equity now, I have huge empathy for that, right? Huge empathy for people that are in that situation. You don't want runaway. You probably, it'd be great to have runaway prices, right? But if we think about and try and think net benefit across society, if we can get 3 or 4 years of a stable market, in real terms, property prices get cheaper, right?
I haven't got the exact numbers, but I would have thought that we've had a 25% reduction in nominal prices, nominal values in Wellington in the last 3 years, and we must have had another 15% due to wage inflation and general inflation and so on. So that's 40% reduction in real house prices. If prices stay the way they are now, for another 3 years, we're comfortably getting to 50% off the peak. So a reduction of real prices of 50% is enormous. And
so, I mean, again, as you pointed out, we've talked about this before, but fantastic time for people to get into the market. And you don't need runaway prices in a hurry. I mean, if you're a first-time buyer who couldn't get in before and you do have a deposit and you can't afford the outgoings, there's no rush, but equally buy a house. It's a great time. We're below long-term averages now.
We don't know how long this opportunity to buy at these levels is going to go for. We don't. We suspect that it might be a wee while, but we don't know. And so, I would agree. The message to buyers is if you can see something that ticks the boxes, make the most of this opportunity to buy when there's less competition, greater choice, as long as you can, be responsible with what you can afford, of course. But don't wait for prices to get lower and so on. Just take the opportunity to get it, and as long as it's going to suit your needs for quite a long time.
So if we were going to make a guess and a prediction for the housing market in 2025, to summarise it, how would you characterise it?
I would characterise it with increasing turnover and small to no minimal price growth, perhaps a very, very small positive number between 0 and 5%.
Okay. I'll have a crack at it. I would say we're going to have more turnover this year than last, but not the same increase as we had last year. Like 30%, it's just not going to happen again. I think because we still have a lack of off-the-plan sales, unit title sales, I think that's going to be that the increase might be 5 or 10% this year in terms of volumes. And I'm predicting probably no real gain, no gains in excess of inflation this year, and potentially not for a long time. But with the caveat that there can be short-term fluctuations, like we saw before the election, where it would bounce back up and it came back down. So it could bounce around, and who knows? But I would say in real terms, unlikely to have any capital gain.
Sounds like we're in violent agreement.
Yeah, exactly.
Yeah. Nice one.
All right, nice to chat to you, Adam. And that was LoweDown. Thanks for tuning in. Please like and subscribe, and we'll be back in to it next week.
Yeah, see you next time.